Hello and welcome to the Harwood Report for April 23rd, 2018, presented by Trade Academy. As always, I am your host and the founder of Trade Academy, Keith Harwood. Standard disclosures to start: all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Do your own due diligence before entering any trades. Highlights. I want to run through what I'm seeing in the equity indices, of course. Bonds are being talked about a lot because U.S. Treasury yields are approaching 3% again. Will that bust through? Will that impact stock returns? Will that impact allocation models? We'll see. But let's take a look at the chart and see if there's anything there to trade off of TLT. Gold got slaughtered today. With everything going on in Russia, the market basically just started selling all those base metals back down. That hit precious metals as well, because part of the reason they were rising was fears about what's going on with Russia and correlations to other metal products. Silver, of course, has a little bit of an industrial use. So all this stuff kind of was going up in hand in a basket. People sold the basket today. And oil looked like it was part of that basket this morning, but now has recovered back towards unchanged. I want to talk through what's going on now in XLE and OIH after those two names in particular have had quite a rebound last week, which were two of my favored longs for the week. But now let's see how the charts are setting up given where oil is. It's going to be an interesting week for tech. We've got tech earnings this week, starting with Google this afternoon. That's going to start to drive some of the earnings expectations. Tech has been a leader for a long time now. Most of 2017 led by tech. Tech has been the bellwether for stocks. If the earnings start coming out negative, start coming out poor, that could start to trigger another wave down in stocks. And on the other hand, if tech earnings come out very strong, that could set us up for new all-time highs. In the meanwhile, the fear and greed index right now is kind of in no man's land. But I want to look at where that greed is showing up according to fear and greed and where the fear is showing up. First off, in greed, difference in 20-day stock and bond returns. That is not an extreme greed situation. This is a situation where bonds are falling, not necessarily stocks rising incredibly. Stocks have risen over the last 20 days. Let's be honest with that. Yes, we've come off the lows, off that 200-day moving average from 3-4 weeks ago. And bonds have fallen. But it's not like this is a situation where everybody is extremely long stocks and just ignoring bonds. I would argue that instead, it is a continuation of the short bond trade rather than the long equity trade. Risk parity was long both through much of 2017. As bond yields rise, bond prices fall. And that helps this safe haven demand thing look like extreme greed. I don't think it is. Where's the extreme fear? Market momentum. The market had that liquidation down there, and that's why over the last 20 days it's rallied, but it helped drive some of that extreme greed apparently. But it's just really sitting at the 125-day moving average. I apologize. And it's really at the 100-day moving average as well, and I'll go over that in the chart. For this market to get greedy, I think we want to see it at least back up above these February highs after that first breakdown. In reality, a real greed market is pressing back towards January highs. We're not there yet. I think this is more important than this in terms of gauging the fear and greed in the market. I believe there's still fear in the market more so than this 42. This 42 marker is being impacted by the way that bonds are falling more so than by the way that stocks are behaving. So let's go to those actual charts now and talk about what we're seeing. First off, the S&Ps started creating this nice little trend higher. Then once it breached through the 100-day moving average, got a pullback here to the 10-day moving average. The 10-day moving average seems to be proving to be support still. So I talked about that last week where the 10-day moving average was the support. We wanted to see a move through the 50 and 100. And start to see the 20-day sloping upwards so that we can start creating more support there. Long-term support at the 200-day moving average still intact. Short-term support of the 10-day moving average still appears intact. That is upward sloping. So the short-term market says go long. The long-term market says grind higher. It's overall still looking bullish. We're at the low end of where I would expect us to be. If the 10-day moving average can't hold, then it goes down to the 20-day moving average, of course. 20-day moving average has not had any significant trade around it recently. That would just be something that the market would have to prove it is a support level. Otherwise, the 200-day moving average is the most clear support level. So if we hold the 10-day moving average, I think we're looking to push back up here towards 276. That is going to be earnings driven. Good earnings gives me $10 to the upside on the S&Ps. Bad earnings gives me $6 to the downside, and maybe, just maybe, it doesn't hold this time, and we got $10 plus. I'm not looking for that to happen this week. I'm looking for that to happen over time. If we have a random assortment of good and bad earnings, then we just chop, and the market sucks. It's a day trader's market in that sense. Really good earnings, again, $10 plus to the upside. Really bad earnings could get nasty. Anything changes with China, Russia, North Korea, NAFTA, that can also drive a material impact on the macro environment. What I'm seeing in the VIX tells me the market is leaning towards the bullish scenario. Slight pullback has not really given a bid to the VIX. It's getting hit again today. Earnings coming out will take more premium out of the market. So if Google has decent earnings, not getting crushed on it, the market will pull premium out of Google. That pulls premium out of the indices. You pull premium out of the big names like Google, Apple, Facebook, Netflix, the general FANG names, Amazon. As these earnings come out, that's going to pull some of the VIX down. That sets up a bullish scenario. What doesn't set up a bullish scenario is if those names come up with such bad earnings that they don't sell the vol. Banks on the whole had fine earnings but negative reactions. If FANG names have fine earnings and negative reactions, I think it's a dip that can set up for a buy for me. If they have bad earnings with negative reactions, the market has a problem. And if they have fine earnings with good reactions, positive reactions, then that really sets up that bullish scenario. And with VIX coming down like this, there's a potential for a trade here. One thing I want to know here is that the VIX is back in contango. May under June, it's pretty tight here. But there's still sellers at the front of the curve, even with the earnings. So that contango should steepen as earnings come out. Now, when I go to SPY, and it's not the cheapest vol on the board, but I just want to give you kind of an example here of what we're dealing with. I was talking about a potential for that move down to 260 with vol bid, or up to 276 with vol coming even lower. From where we're at right now, I can express a trade that expires in, let's go with 3 weeks. Today's the 23rd, 30th. May 7th would be another week. Then May 14th, that's the Monday. 265 straddle is $7, or the 265, 270 strangle is $4.50. That seems too cheap, given the potential for this market to move off of earnings and everything else. We're going to get a lot of information by then that should help clarify the trend. The earnings should help clarify the fundamental direction of the U.S. economy. NAFTA, Chinese tariff information, all this other stuff should start to help clarify some of the macro environment in the world. May not be fully resolved by then, but it should at least have something done. Now, I don't like the May 14th as much because it's $5 increments. If I go over here to the May 11th, so that's the Friday expiration, I can execute a trade much more clearly here. And that would be the 267 straddle for $6.60. Everything is bearish, and it's 664, I guess, right now. If everything is bearish in earnings, I expect to see a retest of 260, if not lower. If everything is bullish, 276 plus. That's $9 on this straddle. So that's kind of the way I'm looking at this right now is, while I want to lean bullish, I'd like to see some of the earnings information first. And until I see that earnings information, the better play for me is to say, in the next 3 weeks, I should see some sort of resolution, and a long straddle helps me play that game. Because SPY is not the cheapest vol on the board, I do this with a straddle. 14% is somewhat cheap for SPY, but it's still well above the November and December kind of levels. I'm not going to tell you the trade I'm looking at IWM here. That'll be in the premium newsletter. But when I go to IWM, you note that 14% is right in the middle of the November and December range. So that vol is cheaper. There's a way to trade that nuance that is better than just buying a straddle. I'll elaborate in the newsletter, as I said. In the meanwhile, let me go back to the charts here. I mentioned IWM, so I'm just going to pull it up here, and I'll tell you how I'm feeling about the chart. Well, when I look at IWM, I'm a lot more excited about this chart than the S&Ps, because this is above the 100-day moving average, above the 50-day moving average, above the 20-day moving average, above the 200-day moving average, and sitting at the 10-day moving average. So again, the 10-day moving average is providing the support, but we have all the other support levels well that are below the market. That's good. That makes me more bullish in IWM, but it also means that as these numbers start to basically collide at 154, that becomes a huge inflection point. If those numbers start coming out bearish for a tech, it will flow through to everything. Small caps can get hit. They are big momentum a lot of times. A lot of times these are the things that people get more aggressive with when they want to see a bullish market. If this market turns bearish, you could see liquidation. Obviously, the 200-day moving average is a quick target, down $6. And again, if the market, tech is going to lead that out, but if the market is getting bullish inputs out of earnings, from the tech earnings coming up in the next week and a half, then we may see new all-time highs in IWM. So it's not necessarily that IWM is the fundamentally bullish input, it's just that the technicals get so clean and bullish as we press above, at 160. You get above 160, IWM is at a new all-time high. That is incredibly bullish, could create some incredible stops, could create some incredible momentum to the upside for the whole market. I go to Qs, and I have a similar sort of setup, except for that we've got a lot of distance to the all-time high. But we're above a few more of the moving averages and really holding at the 100-day moving average here in the Qs. We're below the 50, though. 10 is still holding, but yeah, again, much like it's sort of halfway between IWM and SPY. We've got only really one key moving average above us, but it's a little more bullish setup than the S&Ps. And again, this is where the earnings are coming. So if the earnings are coming up good here, I think we're going to press this towards 172. That's got that $10 of upside. So IWM has a little less upside, but probably a comparable downside if the market goes bearish. Where IWM gets its momentum to the upside is when it crosses an inflection point. So above 160 and pressing towards new all-time highs, that really gets some nice momentum and some interesting plays there. For tech, a decent high that I like tech to make that run. Because if we get above this recent high, it means that, you know, things like Apple not getting hit as much. I mean, we saw some bad performance out of Apple last week. It's not necessarily holding today. You can see that, yes, the magnitude is lower of the drop, but we are really playing around with this 165 level. The thing that could and should hold Apple up, in my view, this week will be other tech earnings. If Google earnings are good, then the money flow into tech should help keep Apple in check. If Google earnings are bad, that could really create a washout in Apple, and that's bad for the market because Apple is a large percentage of NASDAQ and of the S&Ps. Below the 200-day moving average already, clearly that's not the ultimate point because it did have a couple closes below the 200-day moving average. This 155 kind of level could be in jeopardy when Apple has earnings next week. I don't think we're going to necessarily wash out when we're this close to earnings, but people are starting to speculate that there will be bad earnings because of what they saw out of Taiwan Semiconductors last week. So we'll see what happens there. That's going to be the negative right now on tech. So Apple is such a large percentage that if Apple does have a big liquidation this week prior to earnings, that could drag tech down. But again, if Google is good earnings and some of the other tech names are good earnings, I expect to see that nice and firm. Why don't I move over to gold because, woof, what a move today. So we'll start with the dollar, just to look at the index here. And that is a breakout. This level right here. The high was $90.93. Today's high is $90.92. It is just trying to decide if basically 91 can hold. If 91 can't hold, looks like 93 is well in reach. Moving averages here I don't think are quite as important, but you can see we've been in this chopping range. Now we're testing the upper side. It may go here. We'll see. Updates out of NAFTA, the Russian sanctions, China, any of that sort of stuff could really set up a run here in the dollar. More importantly, that's setting up right now in dollar yen. Dollar yen has already started to show a new trend here. It's got the 10-day moving average providing that support. It was chopping a little bit with it, but now it looks really nice and firm. The 20-day moving average is starting to slope up here. Down below here, we still have the 50-day moving average with a down slope, but it's getting close to flat. The dollar yen is starting to look like, you know, maybe we run back up towards this 112 kind of level, the previous range back at the end of December, at the end of the year. If that happens, that's generally bearish for gold. Well, where was gold when yen was at 112? At the end of December, it got down to 118. That's a large downside. Where we're at right now is testing, again, another key moving average, the 100-day. This 124 level is pretty important to me. That's this kind of recent low. Dollar yen continues firm and this stuff doesn't hold. I don't think there's anything that matters about the 200-day moving average in gold. It hasn't done any work there. And frankly, the dollar move is going to be more significant than gold. Gold doesn't just create the 200-day moving average as support if the dollar is moving like crazy, or in the dollar yen. One of the things that is driving some of this is, of course, TLT. So as bond yields increase, people see less value in that inflation hedge because it just means that we're looking at increased rate hikes again. So if you can get yield from a bond, you don't need to hold a cash alternative like gold. It's that simple. So that has helped put some pressure on gold here. TLT, to note, needs to get some direction out of this, but I think it'll consolidate here around the 118 level as it tries to dissect this. So everybody's talking about bonds right now, saying, oh, 3% is a great buying level. Oh, 3% is the breakout level. That drives consolidation. What ends up happening oftentimes is when you hear that kind of stuff, you've got two opposite forces. One, the group trying to press yields higher and force this breakout. And number two, the group trying to call a bottom in bonds for the bounce back. I've been looking at TLT as a straddle play because much like IWM, this vol has been very cheap. Now last week it got down sub 9%. That was pretty ridiculous. Right now at 9.6%, it is still pretty ridiculous. The difficult thing is it's got less clarity to the technicals now than it did a week ago. So last week I was looking at the 120, I think it was July actually. July 121 straddle. Something like that. In any case, what I want to look at now is the fact that A, the front end of the curve is getting a bid because gamma is starting to work a little bit here, but I expect this consolidation. So if I expect consolidation and the front end vol is expensive relative to the back end, and the back end vol is near its low, so that's pretty easy for me. To reduce my short gamma from going into a calendar, oops, don't want to type the vol there, I want to type in a simulated position here. I want to be looking to sell a May 4th 118.5 call. You can either go to May 18th or the slightly cheaper June 15th. I'm going to go with May 18th for a reason. It's less about gamma that way. It's more about taking advantage of this vol distribution, 0.6% higher than May. Yes, this has the next non-farm payrolls. There's some risk there. The alternative is to just sell these guys instead. And since I'm going to go with the safer option so you guys can see it a little better, that's exactly what I'm going to do. So I think that selling April 27th 118.5 straddle is actually not an unsafe move here, but I'll do it as a calendar because that vol's cheap. So what do I have off of this? I have this calendar for 58 cents. If TLT moves like crazy, I lose 58 cents. TLT sits, these decay to 0, these decay somewhat, probably down to about 90 cents, and my calendar is up 50% plus in a week. That is a pretty good trade when I'm looking for consolidation. So that's how I play that consolidation. When I go back to the metals, GLD, it's, to me, a little bit more about how we handle these levels in dollar yen. So there's not a clear trade in GLD. If I go to SLV, talked about this actually in the midweek update. This came right back down. So I've been looking at silver as the way to play long metals if a squeeze happens. Well, that squeeze happened last week. And when we got to this point, this actually became a better short in case of a liquidation, which happened today. I was talking about that on Wednesday in the premium product for those that are not subscribed. So this was the liquidation event, and you could see that it happened today. Now this is back into its normal range, 15.25 to basically 16. Not a great trading opportunity when the vol is not incredibly cheap. Just let me show you where silver vol is relative to historical. 18.5 is fair. If it got down towards 16, then I think this is a better trading opportunity. But at 18.5, I don't see much here. GDX. The miners look like they have more downside to come. This trades a little more with silver. That could push us down below 22. GDXJ. Pretty similar, but a little closer to lows, down towards 31.5. Let me show you there how those vols look. GDXJ, or GDX, sorry. It's kind of in that Nov-Dees range. 21%. GDXJ, though, is about as cheap as it gets. So the juniors are cheap when there's a little bit more liquidation that looks like it could happen here. It's had a smaller move today than in silver because silver had the bigger liquidation to come. I think there's a play here in GDXJ. When I look at the term structure, it's pretty flat. I can add some time, make sure I've got the next non-farm payrolls as an example, and just go to May. Got these May 32 puts for 42 cents. If we get that liquidation here down towards 31.5, that's how far in the money they are. If it happens quickly, these appreciate drastically. If it happens over time, I'm not in pain. And if gold really gets that liquidation back to December lows, I expect GDXJ to make a new low here, down below 30. That creates that big leverage opportunity. So because the vol is cheap here, I can get a cheap entry in GDXJ puts. That's the way I like to look at things. This has got a lot of leverage with gold looking generally weak. So the next leg in gold will dictate whether this is a good trade for me in GDXJ. I want to see that dollar yen continue to firm, and if it does, and gold continues to weaken, then I'm looking for puts in GDXJ. Let's see how it looks tomorrow. But those 32 puts in May for 42 cents are not a bad starting place for me. And finally, I'm going to go to oil. Well, today, the market looked like it really wanted to push oil lower, and look, lo and behold, that 10-day moving average provides support again. Trading right at the Friday highs, well above all of these recent ranges. Oil is just plain bullish. It's the one commodity they just can't liquidate. At some point they will, most likely. But in the meanwhile, can't fight the trend. So what does that set up for XLE? Well, XLE is still sitting near the highs. Get maybe a little consolidation for a couple days, and then pop up towards 77. It's not too bad. And OIH, I expect to see something similar. Consolidating here around 27 for a few days. Maybe at the end of this week, beginning of next, start looking at that pop towards 29, especially going into the end of the month. Maybe the end of the month generates just enough money flow where people want to have some long oil names on their books for window dressing. It's been a good month overall for oil names. At the end of March, closed around 23.5. This is a sector that's really performed well. And it doesn't look bad to hold those names at the end of the month when you're filing your reportings. So I wouldn't be surprised to see a little window dressing on Monday. As such, I think there's some plays with next week's options, but I'll talk about those in the newsletter. And speaking of the newsletter, you can get your first month for free. After that, it's $49 a month. It's pretty cheap. Go through a lot more analysis beyond what I've done here on the video. I also do a Wednesday video update for those premium subscribers. And again, that first month is free. So there's no risk to you for signing up for a month. Cancel if you don't like it. Go to tradeacademy.co/Harwood Report to sign up. You can always contact me, email keith@tradeacademy.co, or call me 312-600-8004. Thanks a lot, folks, and have a great trading week.